Oops, just a minute.
Welcome back to the Retire Young radio show. I am your host, Joshua David, on a mission to improve financial literacy worldwide. If you're just tuning in, Al was shedding some light on how the markets really function. He was getting into, how us as humans or the public, a lot of people trade based off what is happening, or you should trade off what's happening. A lot of people trade off what you think, and that's just emotional. And you want to understand how the institutions are creating these moves in these financial markets. They telegraph, when they're moving big money in these markets, they leave a footprint in a chart. And it all comes down to understanding how to read that chart. And Al, as we talk about how the smart money is doing that, they're always creating income. They're always generating returns. There's no myth about that. That's a fact. They are always doing that. Unfortunately, the public is not. So let's talk about that. Why is there such a big disconnect? But what are some of the things that they may be doing a little bit differently?
Yeah, well, one of the big reasons that there's such a disparity between that smart money group and the public is probabilities. The market does not just go up, although most people are put into a portfolio type that will only profit if the market goes up. The institutions, the big banks, they understand that. They understand that there's three directions this market can go: up, down, and sideways. They are participating in 3 out of 3 of those directions, whereas the public typically is participating in only 1 out of 3. So just from a probability standpoint, it just makes sense that if you have 3 out of 3 chances instead of 1 out of 3, that would be a better choice.
Well, what does that? Sorry about that. What does that really mean, though? Everybody understands when you buy low, sell high, that there's a exchange of capital there.
Correct.
Well, what is the concept of down markets then?
Yeah, well, understand also that everybody listening has the opportunity to participate in strategies that will take advantage of those different market directions. When the market is going down, that's typically when people fear that type of a market. They look at it as something that's bad because they are watching their portfolios go down in value. The institutions are making money. And back in February of 2018, in one day when the Dow was down 1,000 points, Goldman Sachs had $200 million in profits on that one day. Well, they weren't doing that with a strategy that was only participating in an up market. So how do you do that? Well, you mentioned typically when somebody enters one of the financial markets, they will buy something, hopefully at a low price, looking at hopefully selling it at a high price. So you buy to open at a low price, sell to close at a high price. In a down market, a correction or a bear market, you can do what we call shorting, where you're doing just the opposite. You are actually selling to open, so you're selling something that you don't even own. And this is a hard concept for a lot of people to get their arms around. It sounds illegal, but brokerage firms will allow you to do that as long as they have shares of a particular stock or ETF, which in most cases they do. Yeah, they will be happy to loan you those shares to sell. And then you have an obligation, of course, to return them. So let's just say that stock XYZ is trading at $100 a share. You borrow shares of it, you sell it at $100. Now you have an obligation to return it because you no longer have the shares you borrowed. You buy them back, say, at $50 a share. Well, if you sold at $100, bought back at $50, there's a $50 profit. You're doing what you did in a long position, just the opposite in that short position. That's one way of participating in a down market.
I'm glad you kind of explained it that way because it sounds confusing. You're borrowing shares and the broker borrows it. It doesn't make a whole lot of sense.
No.
But just think of it as this way. You open a position on a high when it's high and you close it when it's lower. The difference there is the profit. So That's the concept of that.
Yeah. And one of the other reasons there's such a disparity between the smart money and the public is they do the opposite of what we just talked about. We know that the best thing to do is buy low, buy at wholesale prices, sell high, sell at retail prices. The public does exactly the opposite most of the time, and it's because of the emotions that we talk about, and that's a big part of controlling what you do as an investor or trader. But if you think about this, when you're in your financial life, there's really 2 phases that you go through. One is the growth phase. We're going to call that kind of the pre-retirement phase. That's where you're accumulating things for use later in life. And you're also accumulating or accessing assets or something that you need for your life right now. And then the second phase is the distribution phase when you're in retirement. That's when you need to have something to get you through the next 20, 30, 40 years in retirement. But in this growth phase, this pre-retirement phase, that's where you address current needs that you have to have met now. And then in addition to that, you're also building for the future. Well, one of the problems is that a lot of people, it's being alive is not free. Let me put it that way. It costs money. You have to have a place to live. You have to eat food. Probably have to have some sort of transportation, maybe some insurance. A lot of things there that add up. And for a lot of people, that puts a strain, puts pressure on what they have available then to put into their retirement account. So what Wall Street does often, their advice typically is, you know what, just learn to live on less. Cut back on these frivolous things. You don't need to go to Starbucks. Well, no, nobody needs to, but a lot of people want to. In fact, I hate to admit it, but what's sitting in front of me, Josh?
There you go, Starbucks.
It's a cup of Starbucks coffee.
But I don't want everybody to think that just because you can afford Starbucks doesn't mean you're rich. I mean, we don't want to put that impression out there.
No, exactly not. It's just,
I mean, let's be real. It's a $5 cup of coffee.
But still. I don't think I even paid quite that much for it. But the point is that if Wall Street if that's their advice, learn to live on less, then they're really not giving you advice that is going to be beneficial long term. Why put off gratification until you retire? And by the way, when you go into retirement, they're giving you that same advice: learn to live on less, maybe get a second job, cut back on the size of your house, drive an older car, all of those things. That seems to be not necessarily what people look forward to when they work 30 or 40 years to go into retirement.
Yeah, and I believe that's why there is such a big difference between the institutions or the smart money and the public. Is the public is just told what to do, and kind of like sheep, they follow. And just understanding that there are strategies out there, there are techniques out there. You have to learn them. It takes a little bit of time to do that, but once you understand how to do that, well, you can finish that sentence. Al, let's continue this discussion on the smart money and what they're doing a little bit different than the public. We know the stock market is a great opportunity and why they use that. They also use other markets. Explain what those are.
Yeah, well, the stock market, by the way, is that provides the best opportunity for long-term wealth creation. But what if you have needs right now, things that need to be addressed now? If you're looking for something to help now, you need something that you can use now, not decades from now. And a lot of people are looking at the financial markets as maybe being one way of addressing that issue. So if you're using the financial markets, there are short-term strategies that you can use that are not multiple decade-long goals. So the institutions are using these on a daily basis. They have people that are trading every day, not putting together long-term portfolios, but they're looking for short-term gains. And if that's what is necessary, then these short-term assets are available for people to use. And by the way, Josh, this is not right for everybody. One of the reasons that we do these shows that you were talking about, the classes that you're talking about, is for people to find out whether this is something that's right for you. And maybe it's not. And this would be a good time to learn whether that is the case or not. And if it is something that you feel is right for you, then you start down an educational path that will help you, get to what you're looking at getting. One guaranteed constant in people's life, by the way, are multiple bills. And as I mentioned before, that it's not free being alive. And then what's not constant is always having enough to cover those bills and then putting enough extra or having enough extra to put into what you're going to need for the future.
Well, the income that you create, that actually funds your retirement.
Well, that's where it comes from. You think about it. Anybody who has a 401k, 403b, and IRA, where does the money for that, the investments for that come from? It comes from extra money left over from your income or money taken out of your income. So, and this is one of the things that people are looking at as a way of maybe helping with that, is to have because we always talk about the people that are financially successful in the world.
That's the smart money.
The smart money, they have multiple sources of income, and it's not just a job. They look at other sources, and that's what a lot of people are looking at. They want something in addition to their jobs. And, the markets it's one possibility. Really, what we're doing is just showing you or talking to you about the opportunities that are possible.
Yeah, nothing's guaranteed either. I mean,
Nothing
and
is
that's why I
guaranteed.
like doing the show, because we really break it down to real life concepts. Nothing is guaranteed. But if you put the work into it, well, put the work into it for whatever you're looking to do.
Right. Yeah, you want to put the probabilities in your favor. You want to put the odds in your favor. And one way to do that is to just copy the people that are already doing that. That's the big institutions. But the short-term assets, what we were talking about, if you need something now, if you're trying to address current needs, then these short-term assets that are available to us, that's what the institutions are using. They're using things like the futures market, the foreign exchange market, the options market. All of those different assets can be used in up markets and down markets. And you don't have to just short something to participate in a down market. You can sell a futures contract. You can sell a Forex contract. You can use options that will go up in value as the underlying asset goes down in value. There are what we call inverse ETFs, or inverse exchange traded funds, that go the opposite direction of something. So if it happens to be the S&P 500 inverse ETF, if the S&P goes down, that inverse ETF will go up. So there are multiple ways of participating in down markets. And by the way, options, this is the only asset available that offers the opportunity to participate in up markets, down markets, sideways, and then bi-directional markets. So what I mean by that is that with one trade, one options trade, you can participate whether the underlying goes up a certain amount, down a certain amount, or sideways.
Yeah, when you say underlying, that would be like a stock or an exchange traded fund.
Correct.
And just to continue this on those assets like the futures and the Forex market, they are both open 24 hours a day. So when people work during the day, they can still participate in the evening because it's open still. That's a fact. Also, another big thing is there is leverage.
Exactly.
Basically, there's buying power. So the brokers will actually borrow you capital. So essentially, kind of like a mortgage. If you were to purchase a home, you can, let's just say, take a down payment of let's just say $50,000 to control a much larger asset like a $400,000 home. That's leverage. Well, you can do the same thing in the financial markets. The brokers allow that. Now, coming up in this next segment, I do want to continue this discussion about the futures and especially the Forex market, more of a longer term trading style, because I want to get into retirement, 401ks, IRAs, and the opportunities that the institutions are using that are also available to us. This is Josh and Al with the Retire Young radio show. We will be right back.